So Mark Zuckerberg is planning to conquer the metaverse. However, he must first build it. The question is, can he do it in time before people get angry? And the answer is no. No, he can't. Hey everyone, this is Chris. Welcome back to the channel. So we're talking about Facebook, Meta, Facebook, Mark Zuckerberg thing. You know what I'm talking about, social media. And well, let's dive in. So here it is. They actually got a big downgrade by Bank of America. They're like, yo, you're spending too much money. You got to fire people. And we're not confident in you anymore, Mr. Zuckerberg. And in fact, the stock is down about 3% it's pretty nuts because year to date, down 62%. Jeez, crazy. And also, too, you guys probably know the Snapchat has fallen apart recently due to changes in Apple privacy policy, but that's been a long time coming. Same with Meta has also been affected by Apple's change in privacy policy. The reason why we're making this video today is not only the Bank of America downgrade, but a letter from Brad Gerstner. He's an investor, big time money, who is involved in many tech plays. And in fact, Altimeter Capital and them have written an open letter to Zuckerberg and the team. I have actually not read this letter ahead of time. I just heard about it and like, you know what? Let's go through this stuff together because it's fun. And it's always fun to hear when rich people get mad at other rich people. Essentially what we're talking about here. And I have no idea what's in this thing. I have a feeling it's not going to be very nice, though. So here's the title. This is from Brad Gerstner. Again, he's going to be one of the major shareholders of Meta. Time to get fit. An open letter from Altimeter to Mark Zuckerberg and the Meta board of directors. Okay, what do we got? October 24, 2022. Dear Mark, and again, I haven't read this. This is really fun. Dear Mark, as you know, we are long-term shareholders. Despite public skepticism at times warranted, we have been supporters of the company's strategy to continuously reinvest in product-led future and its mission to make the world more open and connected. Moreover, I am a strong supporter of founder-led companies, especially when they have your successful track record of seeing the future. Okay. So he's very positive. He's like, you know, we've been on a long battle. And I kind of feel kind of bad about this down 62%. I'm pretty sure. And over the last 5 years, down 29%. Oh boy, last 5 years down 29%. Unreal. All right. What else you got to say, Brad? So it's with some hesitation, but significant conviction. I am sharing an open letter strongly encouraging Meta to streamline and focus its path forward. Wow. Some hesitation, significant conviction. I like this language. That's why we do this. It's fun. Like many other companies in a zero-rate world, right? That basically means free money, guys. Meta has drifted into the land of excess. Too many people, too many ideas, too little urgency. Whoa. Okay. This lack of focus and fitness is obscured when growth is easy, but deadly when growth slows and technology changes. Wow. I like that. Too many people, too many ideas, too little urgency. See, I told you guys, this is a barn burner. At the same time that Meta ramped up spend, you lost confidence of investors. Oh, no more confidence for Zuck and the team, I says. The conventional wisdom, press and investor, is that the core business hit a wall last fall. So basically, you can't grow anymore, Mark. You're in trouble, buddy. As a result, the team hastily pivoted the company toward the metaverse. Okay, so the idea was they can't grow anymore. We're doing something else, right? Including a surprise renaming of the company to Meta, which I was kind of not happy about, and I think a lot of people out there were the same. Worse, the skepticism seemed to be affirmed with a nearly immediate and sizable miss in financial results and continued underperformance throughout 2022. So not only did you change your name, you overspend a bunch of money, and now your stock is just awful in 2022. So, man, that's just, and oh, geez. Yeah. I mean, you know, year to date, down 62%. It's not like Google and Apple are struggling, but not that much. Let's keep going more. The facts are startling. In the last 18 months, he's going to reinforce it. The last 18 months, Meta stock is down 55% compared to an average of 19% for his big tech peers. So basically, Mark, you're double worse than other people. Your PE ratio has fallen from 23x to 12x and now trades at less than half the average PE of your peers. Oh, he's saying, man, you suck compared to your friends. That's what's going on here. And notably, this decline in share price mirrors a lost confidence in the company, not just bad mood of the market. So this is funny because sometimes people like to defend of like, oh, I still know what I'm doing. Everything is going down. But when you're like doubly down than everyone else, it doesn't look good. The silver lining is that unlike many companies, this popular narrative obscures the truth. Meta's core business is one of the largest and most profitable in the world, with over 45 billion in operating profits last year alone. So, yes, that is very true. Meta does make money. 45 billion. Oof, that's a lot of money. Moreover, Meta has industry-leading capabilities in key future technologies like artificial intelligence and immersive 3D that will help drive new products and future growth. So he's being positive. It's not like, Meta's got no one, guys. They got engineers over there. They got teams and stuff. It's just, I think we're going with this letter is we're kind of worried about your direction. So, and Meta certainly has abundant financial resources to invest and or return to shareholders. Oh, I wonder if they're like, yo, dude, where's our dividend kind of stuff. But okay, let's see what else we got. But Meta needs to get its mojo back. You lost your mojo, Mark. Meta needs to rebuild confidence with investors, employees, and the tech community in order to attract, inspire, and retain the best people in the world. In short, Meta needs to get fit and focused. So, if you take a look at this here, it's basically saying you've lost confidence with investors, the employees don't like you, and the tech community is like, you know what, there's better places to work. So, and the problem is, younger generations don't like Meta, don't like Facebook, and we're all kind of down on Facebook after the political, fighting and all that stuff. You guys know that. I have Facebook. I barely use it myself as well. And I don't use WhatsApp either. We actually use a different platform. Anyway, what else we got here? To accomplish this goal, we recommend a 3-step plan that will double free cash flow to $40 billion per year and focus the company's teams and investments. Okay, number 1, reduce headcount expense by at least 20%. So basically, dude, you need to fire a bunch of people. And I've been telling you guys about this, that going to recession, there's going to be a lot of layoffs, this kind of stuff. This is, the claws are going to come out. I'm telling you, when you talk about this kind of money, claws are going to come out. You're going to see a lot of this kind of stuff. What else? Reduce annual capex by at least $5 billion from $30 billion to $25 billion. So basically, what we're talking about here is reduce the amount of money you're spending on investing in these kind of things. You see, you go back here, limit investment in metaverse, reality labs to no more than 5. Yeah. So it's interesting because the issue with Facebook, what I'm thinking here is if they've hit a wall from Mark Zuckerberg's point of view, and I'm talking with you guys out loud, Zuckerberg's point of view would be like, well, we've hit a wall. We can't grow anymore. The world is changing. We need to reinvent the company. So therefore, we need to be using our money to go into things that we think that are better direction. I mean, I don't. I get what Alternative Capital is saying. I'm just saying I can see Mark Zuckerberg's point of view, but also too, you don't want to be bloated in doing that, right? So maybe you have too many people, etc. So this is their point of view. It's interesting. So cut your spending, basically what we're saying here. Okay, getting fit, headcount reduction, expense control. The last 10 years have been a unique time in tech, and for Meta, rapid mobile adoption helped market leaders blaze through the S-curve with astounding growth rates and historically low cost of capital, made investments in people and things rational economic decisions. So at the time when money is free and everything's going up, go for it, right? It's your chance to grow big. At Meta, the number of employees is up over 3x from 25,000 to 85,000 employees in the last 4 years. So they've really hired a lot of people. I mean, you guys can see how that creates just a massive amount of overhead that you got to take care of, right? And so you're leaving your less chance for margin. That I didn't realize they grew that much. So that's a good point. After all, why not hire more people and invest in more things when the cost of capital is near zero and growth seem unlimited? Which at the time it probably seemed like a good idea, but today, today the cost of capital has radically changed, and so has Meta's growth rate. It is poorly kept secret in Silicon Valley that companies ranging from Google to Meta to Twitter to Uber could achieve similar levels of revenue with far fewer people. So basically, you're not going to necessarily lose your revenue. You just got to trim your staff. Although also to be fair, guys, this is going to be part of sort of the quiet quitting movement where people are like, you know what? These companies are trying to get more work out of us than they did before. And I think current employees maybe aren't going to like these changes, right? Imagine if your team was 10, you have a regular job, that's your job. Suddenly your team is, say, 7, and now you're working more. So yes, companies' bottom lines improve, but workers' life maybe not so much. I think that's a real concern. I would take it a step further and argue that these incredible companies would run even better and more efficiently without the layers and lethargy that comes with extreme rate of employee expansion. Okay, I get that. You just get too many people too quickly, hard to manage. Okay. As such, we are encouraging companies to move aggressively and cut at least 20% of employee-related expenses by 2023. you know what? In this example too, he's saying employee-related expenses. So theoretically, you could be cutting, the free food at Meta and these kind of things, like not just headcount, but also the benefits that would be part of it. Why 20%? To put that in perspective, it merely takes a company back to the mid-2021 levels of employee expense, and I don't think anybody would argue that Meta wasn't sufficiently staffed in 2021 to tighten the business that looks similar to how it looks today. So basically, he's making the argument that you guys did fine before. Just go back to where you were doing before. Okay, that's reasonable. We do not take job reductions lightly. Well, the people who do obviously take it very seriously. They don't take it lightly, but yeah, I get it. These are not numbers on a spreadsheet. They are people with families and kids to support. With that said, we have a shortage of talent in Silicon Valley. Meta and other large companies have made it very difficult for startups to hire. Oh, we are confident that these employees will find replacement jobs and quickly be back to work on important inventions that will move us all forward. So he's making the case, don't worry about the employees that you fire. They're going to be fine. They're talented. They'll get other jobs. Who knows if that's true, but that is a mindset that you could be in if you're firing people, is that we're firing talented people, they're going to be fine. Like I said, I don't know if that's true, but I get that argument. CapEx investing aggressively and responsibly in the future of AI. So I'm with Brad Gershon on this one. I think AI is one of those areas. AI and cybersecurity. If Meta, Facebook were to get in these things, I think those are two areas that are fantastic. I've said these things before, over and over again. Over the last 3 years, Meta has dramatically increased its capital expenses, even including large metaverse investment. Meta has gone from $15 billion in annual capex in 2018, 19, and 20 to 30. So basically doubled their investment stuff. To put that in perspective, excluding your large metaverse investment, Meta is investing more in capex than Apple, Tesla, Twitter, Snap, and Uber combined. Oh, I didn't know that. I actually didn't know that. Wow. That sounds insane. That sounds really crazy. Okay. Yeah, Mark, you're pretty crazy, my friend. Some companies require tremendous cap investment to maintain their existing business. Our best guess is the maintenance capex for Meta is less than $10 billion annually. The vast majority of capex has been an essential and high return investment in data centers, NVIDIA GPUs, and other AI resources to solidify the company's business as one of the world's leaders in AI. So yes, AI, go for it, Mark. We believe that the future lies in AI. I'm with you right there with Brad on this one. In fact, we believe that augmented and artificial intelligence has the potential to drive more economic productivity than the internet itself. Well, I don't know about that, but it's certainly important. AI and augmented. I don't know about augmented. I'm not sure about that. Augmented, like the goggles, and that helps you like fix cars better or go shopping. I mean, maybe. And while most companies will struggle to monetize AI, we believe Meta is incredibly well positioned to leverage AI to make all of existing products better. Interesting. Okay, so not only do you think that they can develop AI, but they can make it profitable and make money off of it, which at the end of the day, that's what you want as an investor. Whether it is making WhatsApp more seamless or making content ads more useful on Instagram, Reels, and Facebook. Oh, okay. AI is a globally scarce resource that is already driving noticeable improvements of Meta's 3 billion customers and advertisers. So see, the thing is with Meta, they got such a large platform, and your AI could help users find stuff better, right? It can adjust information, it can process information, these kind of things. So Meta is a data company essentially. So I get where he's going with this. We also believe Meta's investment in AI will lead to exciting and important new products that can be cross-sold to billions of customers, from Grant Teton to the Universal Speech Translator. Oh yeah, I can see that. To make a video. Interesting. We are witnessing a Cambrian moment in AI, and Meta is no doubt well positioned to invent and monetize the future. I like that. Invent and monetize the future. I like that. Brad's a smart guy, guys. With all that said, we believe the company can responsibly and reasonably rein in CapEx while continuing to invest aggressively in AI and other critical areas. As such, we think that during this period of growth, transition, and economic uncertainty, the company should decrease CapEx by at least $5 billion and maintain its discipline until revenues reaccelerate, bringing our CapEx as a percentage of revenue more in line with other CapEx peers. At 20 to 25 annual CapEx, Meta will still be investing market-leading amounts to help invent future AI. So yeah, that was the big discovery for me, that they're investing way more than Apple, Tesla, Twitter, Snap, and Uber combined. So yeah, this is too much money that they're putting in this stuff. I mean, Zuckerberg, though, but theoretically, we could all be idiots, and Zuckerberg is betting on the future, and the future is metaverse. I'm saying theoretically, but I have heard reports that a lot of the employees are like, dude, you're spending too much money on this stuff. You'd be crazy. But like I said, for all we know, Zuckerberg could be right, but, who knows? Evidently, Brad doesn't think so, though. Let's see what else we got here. Focusing the metaverse, the next generation of communication and collaboration. Okay. While increased AI investment clearly well-timed, Meta's investment in the metaverse, which while smaller than AI investment, has gotten the most attention and has led to much confusion. Interesting. Okay. Yeah, this has actually been a thing, guys. I didn't realize that AI was bigger investment than metaverse. I was even fell for that. So Brad is pointing that out, that or this is a little bit of smoke and mirrors here, perhaps. But I'm going to trust Brad is telling the truth on this one. Perhaps it was the renaming of the company to Meta that caused the world to conclude that you were spending 100% of your time on Reality Labs instead of AI or the core business. Whatever the reason, that is certainly the perception. In addition, people are confused by what the metaverse even means. Okay, I get that too. Even if the company were investing $1 to $2 billion per year into this project, then that confusion might not even be a problem. You would simply do R&D quietly, and investors would focus on the core business and breakthroughs in AI. Yeah, that name change thing really, confused a lot of people, I think. What else we got here? Instead, the company has announced investments of 10 to 15 billion per year into a metaverse project that largely includes AR, VR, immersive 3D, Horizon World, and may take 10 years to yield results, right? An estimated 100 billion in investment in an unknown future is supersized and terrifying even by Silicon Valley standards. With all that said, this is saying it's just too far away, 10 years away, and too much money. With all that said, we truly believe that the company should be making some important investments. Dave Bazuki of Roblox describes the metaverse as a natural evolution of communication, a multi-device world, including the phone, that is best thought of as a better version of text, video, and voice that will make us feel more connected. And maybe these people are right. Maybe metaverse is going to replace text, phone, and all that stuff. I'm still leery of it, but maybe. Of course, a company that connects nearly 3 billion users on phone and text must be investing in the next generation communication. Okay. But what is the right amount? By any normal company or startup standard, $5 billion per year would seem like an extraordinary amount, right? I mean, that's a lot of money, guys. $5 billion a year. How much do you invest? I've been told that Amazon spent far less to total build AWS, and so this is an example that Brad's saying here is like, dude, you're putting like $5 billion. Well, actually, putting a lot more than that, but just you're investing all this stuff in metaverse, and like, Amazon, and this is a huge cash cow for Amazon. Is AWS is a massive cash cow for Amazon. And essentially, like, they do a lot of web hosting, they do a lot of storage and things like that. A lot of companies and things that rely on Amazon's hosting services and other products, business products essentially, web services and stuff, and data centers and things of this nature. And Amazon's killing with that. That's keeping the rest of their business afloat. And so, Brad's saying like, look, you could have invested your money in like AWS stuff and got major money back opposed to just wasting it on this metaverse thing. So I think this is interesting. As such, we think Meta company should cap its metaverse investments to no more than $5 billion per year, with more discrete targets and measures of success, as opposed to today's much more ambitious and open-ended strategy. So basically, he's saying $5 billion, dude, is still a lot of money, and you can still get there, but just trim it down a bit. We have little doubt investors and others would be happily support scaling up these investments as the ROI becomes more tangible, even if long-term. So here's the conclusion. A leaner, faster, more successful Meta. The cumulative benefit of recommended adjustments outlined above would increase free cash flow by at least $20 billion in 2023. That's $10 billion from people-related expenses, $5 billion from CapEx, and $5 billion from reduced metaverse spend. Okay, this would double annual cash flow, free cash flow, and put free cash flows as a percentage of revenue more in line with Google, Microsoft, and Apple. So it's like, dude, manage your money the same way that your peers do, and you'll look not so crazy. There is no doubt that doubling annual free cash flow will improve share price, right? It's all about share price. I mean, that's what investors want. Of course, it's not crazy. And while ultimately is an important long-term measure of success for all Meta stakeholders, it would be imprudent to make short-term bad decisions just to improve the share price. Okay, so he's saying like, don't be buying back shares and stuff like that just to make people happy. Manage your company better. I think that's what he's saying there. Or like, don't offer a dividend if that just to make people happy, improve just think about long-term opposed to short-term happiness. I think that's what we're going for here. But far from being a bad decision, we think the recommendation outlined above will lead to a leaner, more productive, more focused company, a company that regains its confidence and momentum. I have spent 20 years investing behind some of the world's most great founders who are helping to invent the technologies that move the world forward. I have deep respect and admiration for founders that continue to grind, inspire, and invent long after the financial motivation is gone. There isn't a day that goes by where I don't find myself using Meta's products to communicate, to connect, and to entertain. I'm still amazed at the power of these services. We don't have any demands. We simply wanted to further engage and continue sharing our thoughts as an interested shareholder. We believe in this team. We know Meta has more reach, more relevance, more incredible opportunities for growth than almost any platform on the planet. And we are confident that your long-term investments in AI and next generation of communications will continue to drive us all forward. As always, happy to connect with you and your team. Best, Brad. So, guys, I think this is a fantastic thing, especially for, and this is just in general, not just as an investor, not just as someone interested in finance, but I think one, as a professional communication letter to talk to someone about real money, real business decisions. I think this is great for you guys to learn these kind of things. I know there's a lot of college students that watch this show, or even people who want to start their own businesses. Just look how Brad communicates, right? You're given essentially the tough love talk of like, dude, you got to cut it out. You're even talking about cutting people's jobs, right? Real stuff. You're talking about the future direction of someone else's company, and you're doing it in a very professional way. I thought this was presented very well. I didn't feel like it was disrespectful in any stretch of the imagination. And so this is a brilliant letter. And he did an open letter, so everyone was going to read this. So I'm just saying for future people out there, and this is the kind of thing that I would, what we're doing right now on the channel, but I would make my students read and study and then like think about the rhetoric and the message, not just the financial message of, how do you run your business and how do you manage money, but also to how do you communicate that? Because guys, relationship is everything in business, right? You don't want to like say, hey, Zuck, you're terrible. I'm just dumping all your stock. Screw you. Bye-bye. That kind of stuff is you're like, hey, we're partners in this stuff. We want to make money. We think this is a better direction for the company. But this is a real big deal. And this share price is down. Actually, what are we doing today? Oh, hey, wait, look at this, look at that. So maybe this is live as I do this. Maybe as I was reading the letter, the stock price jumped back up because maybe it was a new announcement by Zuck and the team or something like that. That's really funny because it was crashing in the morning, but bouncing back. But we'll see. So love to hear your thoughts on this thing. I agree with Brad on this stuff. My feeling though is it's Zuck's company. He can do whatever he likes. I personally don't see the metaverse thing. I don't get it myself. I don't want to wear the goggles. I've meant that several times. I did a review on it. If you want to watch that, I'll link to this. But I do think the investment in AI is worthy, and I would be dumping a ton of money into AI. I think that is a big part of the future, as well as theoretically Meta could get into AWS. It didn't even occur to me. It's just something to think about because I do think their Facebook model is what's the word to say. They still make money on stuff because like you guys don't know in USA. Maybe people are tired of all the political stuff, but in other countries, the Facebook boards and stuff like that, like you can find houses, jobs, their marketplace thing, like theoretically they could try to compete with eBay. I'm just saying that there's a lot of opportunity out there because they have such a large user base internationally. It's not like the company's going to disappear yet. I say yet because you never know what can happen in the future because advertising is going to slow down for companies like Facebook. But I think some of the stuff that Brad is talking about is not unreasonable. So we'll see how Mark responds and how shareholders respond and see how you respond. So thanks again for watching. Hope this was useful, fun, and helpful for you. And I'll see you in the next video.